Welcome to the Achievable FINRA podcast. I'm Tyler, founder of Achievable. We have affordable FINRA courses for the SIE, Series 6, 7, 63, 65, and 66. We have industry best pass rates, and each Achievable course includes everything you need to pass the first time. This includes a full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, the code podcast gets you 10% off at checkout. Also, if you have a question or a topic you'd like us to discuss in a future episode, you can email me at tyler@achievable.me with the subject line podcast topic. Now let's get started. So today on the show, we've got a good friend of ours, Ken Finnen. And Ken, why don't you introduce yourself real quick?
Hey, how are you, Tyler? What's going on? So, just a little bit of background. I worked on the stock exchange. I've been in the business for God knows how long, since before most of you guys were born. About 15 years ago, I started teaching, and just like as a casual thing, and then just kind of build up to a thriving business. Now I have a bunch of YouTube videos on YouTube. I have TikToks under Blue Collar Finance. I have my own little podcast. It's fledgling, and we're trying to build out. So I have a lot of YouTube videos that'll help you. And as I tell everyone on this exam, every topic, I've either sold, traded, or fired someone for violating the rule. So I know this stuff pretty darn cool. Okay.
Cool. We're doing good. So today we want to talk about U.S. government debt, basically.
Sounds good.
And I think there's first let's just outline, as you just did with me, as we were talking before the call, all the different things that exist in the U.S. government debt universe.
Right.
And then let's go through them. Because I think, first off, they're tested on the SIE and a bunch of other things.
Yep.
But then also, a lot's going on with them right now.
Yep.
in the world.
Yeah.
So.
Sounds good. Okay, so first of all, understand when we talk about government debt, we're talking about the federal government, the U.S. government, which can print their own money. So they will never really. They're this. In reality, our government debt is the reserve debt for the whole world. We're the safest. We're AAA plus. We have no default risk because they just print new money when they want to. So when people buy these things, you're always thinking safety first. Whenever somebody says safety or protection of principle, you're going to lean toward governments. But there's a lot of different types for different types of people. So let's talk about the big ones. Okay, so I always say it real quick: bills, notes, bonds, tips, and strips. I just say it quick. It kind of rolls. Bills, notes, bonds, tips, and then strips. And they all have different features and good things and bad things about them. So let's start with the tiniest one. T-bills. These are the short-term, they're considered money markets. They're really short-term. They're really about parking your money. So like a T-bill, you can get them in a 1-month maturity, 2-month, 3 months, 6 months, or even a year. But now, if you know anything about bonds normally trade, they pay their interest every 6 months. But you can't really do that with a 3-month or a 2-month bond. So what they do is they buy it at a discount. So it's a discount. It's what they call a zero coupon. So it's a discount security. So what happens is you're going to buy it at $990, $990, $995, and then receive the $1,000 at maturity. So you buy it at $990.
So that's how they do the interest, basically.
Yeah, exactly. That's your interest, right? Like if you lent your buddy money, if your buddy said, "Hey, listen, can I borrow $25? I'll give you back 30 in a week or two." That $5 is your interest, exactly. But you're really buying it for very, very short term. It's really about just parking your money. So in case you have a deal, or say you have a house, like my daughter's buying a house in 3 months. So we put all our money in money markets, but this is one that you could put in. In reality, retail people don't really buy these. This is more for if Elon Musk was going to buy Twitter, just say that was a thing, okay? And and he wanted
that might have happened.
Exactly, and he's going to close next week. He would probably have as much of his money in T-bills right now so that there's no real risk. And when people are really worried about the market, they run to safety, they run to the government. Now, an interesting thing about T-bills, in 2008, we didn't know what was going to go on. I mean, really scary time of the market to people, but you knew that T-bills would pay. So people bought T-bills at such a rate, and when you buy stuff, price goes up, that the actual price of the T-bill was above 1,000. So actually, you were buying a T-bill for $1,001 and only getting back 1,000. So you're actually losing money on the deal. But because
just to not lose more money in the market,
exactly,
right?
exactly. That's all they were doing. They were just doing say, listen, I'm so afraid of what's going to happen. Bear Stearns goes out of business. Lehman Brothers goes out of business. Citibank was about to go under. We don't know what's going to happen. AIG. So they said, look, just buy the T-bills. I don't care. I'm willing to lose a little bit of money to make sure that I have it tomorrow. So that's really what T-bills are all about, the safety stuff. And they're the most liquid security. Yeah.
And I will say, like, you know, my assumption, and just to kind of flesh this out for people, is that like this is dealing with amounts of money where you can't just like withdraw from E-Trade and put it in your savings account, right?
It's talking millions and hundreds of millions of dollars, right? Exactly. You can't go to the bank and go, here, can I take out $10 million? It's legit money, right? So, absolutely. So that's kind of T-bills. They don't go over a year. They're considered a money market. They're the most liquid, most actively traded security there is. Literally cash. If the bank had the money, you could walk in with $500,000 worth of T-bills and walk out with cash the next day. It's that interchangeable. They don't have that money, but that's the thought process. Okay. So that's the short-term stuff. Now let's go a little longer. Maybe like a medium-term thing is what they call a T-note, Treasury note. T-notes are have a maturity of 2 to 10 years. Again, super safe. Now, the one thing about this is that since they're 2 to 10, they actually can pay a coupon. So remember, bonds pay every 6 months. So if you need money in if you need guaranteed money in 3 or 4 years or 8 years, you could buy a T-note. You know you're going to get your $1,000 back because you pay $1,000. It pays you interest 3-4% every year, twice a year, and then at the end you get your $1,000 back. And it's super safe. Again, they just print money if they run out. So that's what that's a T-note, not much different than a T-bond, which is up to 30 years, right? So a T-bond is the same thing, but it's up to a 30-year product. Again, pays every 6 months. You buy it at 1,000, you get it back at 1,000. These are called term bonds, if you want to call them, because they're a specific term: 2 years, 5 years, 10 years, 15, 30, whatever it is, and you're going to get paid interest every 6 months, guaranteed. Now, but here's the thing: their rates are going to be pretty low. Not recently; they're going up and up and up because of what's going on. But they do pay a very low rate because what don't they have? They have no credit risk. And think about the biggest thing, Tyler. Like if you lent me money, what's your biggest fear?
Don't pay the money back.
Whoa, that's kind of insulting, but that's okay. But right, so you're gonna this
is a hypothetical situation.
Exactly, it's hypothetical, right? So your biggest fear is that I'm not going to pay you back. So the credit risk is not there because the government go, oh, you need money? Hold on, cha-chink, they print. Just like Jerome Powell's been doing for the last 3 years. Okay?
Right.
Just printing money like crazy. I'm not going to shit on him because it's been the last 15 years. But we've been printing a little bit of money lately. So the T-bonds and T-notes, they are actual coupon-paying bonds, what they call interest-bearing. Even though you're getting interest with a Treasury bill, it's not to the end, so it's not considered interest-bearing or interest-paying. It is interest, but it's not considered that way. So you have T-notes, 2 to 10 years. They pay a coupon every 6 months. And I think that works. T-bond, same thing, but it's up to 30 years. Now, when we do quote them, I can't talk about it on a screen or anything, but when you buy and sell these things, they're so active that they can't use the normal eighth of a point to trade them. They have to be traded they cut it even more into 30 seconds. Not the time 30 seconds, 1/32s. Right? So each 32 is worth it's a 32nd of a point because they're so active that they have to have that small of an increment in trading. So if you ever see a bond that says like 104-25 or 104.25, it's actually 104, and that dash and the number after it is how many 30 seconds it is. So if you see 105-04, that's 4 seconds, which is an eighth. Okay? They just had to be different, right? But that's why they do that. So you will never, if you see 104.25, that's not 104.25. That's 104 and 25, 30 seconds, which I think is like 0.78 or something like that. So
they could have just done percentages, but I guess this is all created back in the day before computers. So.
Yes. Well, think about this. Before that, even stocks used to trade in eighths up until the late 90s. So when I bought a stock, it was an eighth. So we always did fractions back then. And it was only recently. Yeah.
I was gonna say it must have been a lot harder to buy Berkshire Hathaway back then.
Oh yeah, exactly. Well, it's funny. It was only 100,000 a share at the time. Right now, it's what 350. Right? Yeah, exactly.
Yeah.
So it's funny. All through the 90s and early 2000s, if you gave me a fraction, I could rip it off. In my head, I just was doing it. 0.375 because you just lived in it. So that's what these the people who trade treasuries, like my old firm, they manage treasuries. He just talks about, like, he does the numbers in his head like crazy. It's like if you tell him 18, 30 seconds, he goes, "Oh, it's this." I'm like, "How do you do that?" Just from practice, right? So those are the main three ones that we talk about: T-bills, T-notes, T-bonds. Now, let's talk about risk a little bit before we go into the other two. T-bills literally have no risk. They're actually called the risk-free rate of return. And the 90-day T-bill, which is a 3-month T-bill, 91-day, 90-day, has zero risk at all. There's no interest rate risk because it's too short. There's no inflation risk because it's too short. There's no reinvestment risk because there's nothing to reinvest because you're not getting the money to the end. And there's no credit risk, obviously. But if you go into the T-note or T-bond, you're getting paid every 6 months, and it's a longer term. So some of those other risks start creeping in. So on a T-note, we have some interest rate risk because, if interest rates go up, the prices go down. We have inflation risk because it's obviously what we're going through now, 10% inflation. It's crazy. We have reinvestment risk. We have inflation risk. We have interest rate risk, all those risks. But the longer the bond, the more inflation, more those risks come out. So the T-notes have some of that, right? Then we have T-bonds, which are up to 30 years. They have a lot of inflation risk. They have a lot of interest rate risk, and they have reinvestment risk. Again, reinvestment risk is when you get paid, what are you going to do with that money? You're going to have to reinvest it. Now, if rates are down from when you bought it, you're going to have to reinvest that money at a lower rate. Does that make sense, kind of thing? Okay.
Yeah.
Okay. So what they did was they go, wait a second, we have some issues here. Let's get rid of some of these risks also. So they created a TIPS, a TIPS. Sounds like different, right? So TIPS, Treasury Inflation Protection Security. That means it's going to adjust for inflation. You're not going to beat inflation, but it's going to adjust. So if you have a 5% $1,000 bond that pays $50 a year, if inflation is 10%, the par value will go up to $1,100, and you're still getting a 5% bond of a $1,100 bond. So now you're getting $55. So inflation went up by 10%, and your payment went up by 10%. So you're not losing to inflation. That's kind of where that is, okay? So that's why they created that, is to say, okay, we have inflation issues. People don't want to buy a T-bond because they get killed by inflation. So they buy a TIPS. But if you're thinking on the exam in general, you don't really recommend that to someone unless they mention they're worried about inflation risk. Because again, and I haven't said this, every time you take a risk away, they pay less. The safer something is, the less they pay you. That makes sense, right? So if I have a TIPS that took inflation risk away from a T-bond, it's going to have a lower coupon. You're giving up that return to get the inflation protection. Like over time, you may actually have a higher coupon than the old bond that you would have bought because of inflation. Are we okay with that? That makes sense, kind of thing. I'm not.
It's a hedge, right?
Unbelievable.
Because essentially, if you buy, let's say a 30-year T-bond, and I don't know, I'm just gonna like really rough ballpark it. Say it gives you back 2% a year, and then inflation basically goes up 10%. You are losing money.
Yes, I mean
your money is parked in a place that's 100%. Giving 2% a year.
Well, that's why they come up with a thing called the real rate of return. Real interest rate. The real rate of return is your return minus inflation. So let's do it now. So Treasury. So what's been going on? The Federal Reserve has been tightening and raising rates, which means all the rates are going up. So the Treasury is around. I think the 10 years around 4% now, 4.1. It's right around 4%. Okay, which is compared to a year and a half ago, they were like under 1. So they're actually becoming a valuable thing to invest in. But think about it. You earn 4%, like what you said, but inflation is 8%. You're actually your real rate of return is actually -4 still.
Right, and at that point, you're making the bet, roughly speaking, that if inflation comes back down, and then you're in the positive for the last 25 years.
Exactly. Yeah. So if you can time it right, say that. So next month they're going to jack it up again, maybe 1 or 2 more times, depending what happens. If you can grab yourself a 5% or a 6% Treasury bond, and then rates start dropping, you're gold.
Yeah.
Right? I mean, that's a good. And then if
It's
inflation
free.
goes
It's
back
basically
to 2%,
free money.
yes,
at that point.
exactly, exactly. Well, that's the thing. So it went the other way around. So for the last 15 years, the rates were so low, it was people could borrow for free, right?
Right.
And now, if you do this right, if the rates go high enough, if you buy these bonds, you're getting, and then the rates drop, you're getting better money with no default risk. So it's awesome. It's a good. It's not a great situation, but if you kind of think ahead of time, you can probably game it a little bit. Like my daughter's going through the house.
Also,
yeah.
I was gonna say too, like, I mean, things that are great situations, like in the stock market from an investor's point of view, talking about investments,
Right,
are different than like what's great for the real world.
Yes,
and that's okay. Like, I
Yeah.
think we're mostly just talking about the investment side of things,
Right. Yeah,
for
exactly.
this.
So, and that's the thing. So we don't really care about the issuers too much, and we're not global macro stuff. But I mean, in reality, maybe buying bonds not right now isn't the best idea because the rates keep going up. But at some point, it's going to be so attractive, it'd be hard not.
Right.
Okay.
Well, and that's part of the reason why, which is a topic for another time.
Right.
Part of the reason why all of the currency money is like flowing into the U.S. dollar.
Yeah.
Is
we're the
because
shit.
it's just it's the best place to park,
Right?
And it's got the best deal in town at this
Right.
point relative to safety.
Well, we're the reserve currency, right? We're the reserve currencies in the
Yeah.
world. Since the war, used to be the pound. Now it's us because we've never defaulted. Where I think, if I'm wrong, I'm not wrong. Who knows? I could be. I don't think any other major country has ever not defaulted on some sort of bond. So that's why it's a big deal when they go, oh, when they were standing up and not going to raise the debt ceiling. If we ever defaulted, we're screwed. If we default, I think the entire economy of the global economy crashes.
Yeah, it's not good. Which is not a fun thing to play chicken with. But that's neither here nor there.
Right. So if Russia defaults, who cares? I mean, it's bad, but if we default, the whole world goes nuts. You better hope you have a cut.
It would be bad.
Yeah, exactly. So okay, so that's the last one is called a strip. The name of it is secured Treasury. I think it's secured Treasury registered instruments in principle. Doesn't matter. A strip. Think they strip off the coupon. It's actually a long-term zero coupon. It's like a T-bill, but 30 years. So you buy it now. Lately, it hasn't been a great one, but now it's getting better and better because the interest rates are getting higher and higher. So what happened is, like, say you have a kid, so like Brandon has a kid, right? So for Brandon, say the baby, 6 months old, they could buy 18-year T-bills, strips, right? So they buy a T-bill. I'm going to say T-bill all the time. They're going to buy a strip that matures right before that kid's going to go to college. So say they think
it's parked money. Yeah.
Yes, and there are issues with it, but you buy it. Say you buy a $300 bond now. When they're 18, it's $1,000. So maybe you buy like 10 of those for $3,000, and then you're going to get a check for $10,000 right before they walk into college. Now, hopefully that's enough, right? But that's the goal, okay? But you do have risks with that because you have a lot of inflation risk because it's not adjusting, and you do have to pay taxes on that every year. The IRS is a son of a bitch, right? So the IRS, hopefully they don't come after me for saying that, but what they do is they make you take...
The IRS is for better or for worse, pretty good at their job.
Yeah, I know. No, I know. That's the sad part. That's good and bad, right? So what happens is every year that you own the bond, they will say, okay, a portion of that, even though you're not getting the money, we're going to tax you on. So it's called accretion, which is, there's videos and stuff on that. So if you buy it for $3,000 and then it grows to, $10,000 in 18 years, a little bit of that increase every year is going to be taxed for you. It's called phantom income that you're paying taxes on. So you should probably put that in either an IRA or like some sort of a Coverdell or something, some sort of deferred tax account. So then you're not paying taxes till the end. And if you do it in a Coverdell, then you don't have to pay taxes ever on that, which is great. So that's how we get around the IRS a little bit. So those are the main 5 ones. Bills, short-term, notes, medium-term, bonds, long-term, tips, hedge against inflation, and strips are just for long-term zeros. And FINRA loves them for college savings. Because it's like it's target-based investing. Like if you knew, Tyler, that you needed $5,000 in 2 years and you needed it, no risk, no that, you could buy a 2-year strip, say, for like $4,000, knowing that it'll be $5,000 when you need it. And that's why you do that. And that's what they do. Now, one quick thing before I move off that, there's a thing called Treasury receipts. They are not issued by the government, but they're conflated with them. Treasury receipts were what happened in the early 80s. The broker-dealers would buy Treasury bonds, put them in their bank escrow account, and then issue these long-term zero coupons based on the bonds. So as a Treasury receipt is, to you as an investor, there's literally no difference between a receipt and a strip. But a Treasury receipt,
there's a middleman involved.
Yeah, exactly. So you may get a little bit less return, but so and if I may be wrong on my history here, but I think the receipts were done first, and then the government goes, "Hey, that's a good idea. We can do that without having to worry about them." So the Treasury receipts and Treasury strips both pay at the end. You get your money at the end. There's no interest. There's no you're not getting interest during the life of it. Those are the main ones. I mean, there's other agencies and stuff like that, but that's the biggest thing about them is that you're buying them for safety.
Right. And so then maybe the way to wrap this topic up is just to talk about how they all function in respect to suitability.
Sure.
Because that's probably the most
absolutely
important, application of them on the test.
For the test, for the SIE, we're kind of done, right? But if we're going to jump into the 7, let's go a little deeper. So if I am an investor and I'm going to buy a house, or I have a kid going to school or something in the next 5 to 6 years or shorter, I'm not worried about getting interest. I'm just worried about not losing my money. So what I'm going to do is I'm going to buy like a T-bill or something. So remember, if you hear park your money, safety of principal, protection of preservation of capital, like fear of, and they don't want income, you do T-bills because you just park them and you leave them, which is where we go. And that's the thing a lot of the vendors, they leave some things out when they talk about suitability, okay? To make you figure it out. And I get it. You're trying to make them close the gap on their own. On their real exam, they will give you what you need. They will say, the person wants safety. They want this, and they need income. Well, if you hear the word income and safety, it can't be a T-bill because T-bills don't pay. So if you hear safety, government every time. Then if you hear income, then what you're going to do is you're going to go to you're going to buy a T-note or a T-bond, and then you base it on length. If they say I need money for 2 to 10 years, you do a T-note. If they say, look, we want income, but we want safety, and they're like in their 40s, which you would never really do this, but if they want no risk and they want income for 20 or 30 years, you would do a T-bond. Now, and again, if they say they want income and safety, but they're worried about inflation or purchasing power risk, what do we go to? We go to a TIP, right?
Right.
And then if they say college savings, you're going to do this. They're going to do the strips.
Yeah.
Now, I'm going to add one thing I'm not going to do the deep dive on the mortgage-backed securities because that could be another conversation. But Ginnie Maes, just remember this, Ginnie Maes are the only one that are actually backed by the government. And before you ever pick Ginnie Mae, they pay monthly. So they will have to say, I want monthly income. I had a question on one of my exams like 2 years ago, and it said they want safety and income, and they gave me a choice of T-bonds or Ginnie Maes. And at first I'm like, crap, I like them both, right? But I went with it. I said, wait a second, they didn't say monthly income, because that's what Ginnie Maes, they're mortgage-backed securities. People pay their mortgage every month, hopefully, so they get paid every month. T-notes, it didn't say monthly, so I go with the T-note every time. And really, that's the suitability of it. I mean, it's not hard. Everyone makes it harder than it is. They worry. But if you just follow the rules, I think safety, my money automatically goes to government.
Right.
So, now, one good thing, this is not less FINRA stuff, but it's an interesting thing. You should think that the longer something is, the better the return is, right? So if I have a 2-year bond versus a 10-year bond, the 10-year bond should pay more than the 2-year. Does that make sense? So
do you want to explain it though, just to kind of
so here's the thing. So let me do it this way. So Tyler, if you lent me money for 2 years, maybe I'd pay you 3% because that's your risk. It's not that long. But if I said, Tyler, I need the money for 20 years, you want to be paid for that.
Yeah.
So I'm going to say, listen, you're going to go, I have to pay you like 6 or 7% because I'm paying you for more risk. The longer something, so the T-bonds will always pay higher than the T-notes, and the T-notes will pay higher than the T-bills. Except for now. Right now, since the Fed is raising rates so much to combat the inflation, which is what they should do, we actually have what they call an inverted yield curve. So the 2-year is actually at like 4.3%, where the 10-year is at 4.1%. So we have an inverted curve, but that's usually a sign of a recession, right? And that's what they're trying to affect. And this matters. So an inverted yield curve means that the shorter yields are paying higher than the longer yields, and that's not a normal situation. That's like me paying you more to borrow money for less time.
Right, but it's because in the short term, interest rates are going to be higher than the long term.
Yes.
Hypothetically.
Yes.
Yeah.
And that what'll happen is eventually, so short-term yields move more than long-term yields because that's where the Fed plays in the short-term overnight stuff. So if the short-term yields go up, eventually the long-term yields will catch and pass them. But in the beginning, you have an inverted yield curve. We had it in 2008 too, a short one. But right now, 2-year over the 10-year is a sure sign of a recession. So I hope that helps a little bit.
Yeah, that does help. Thank you so much. This has been Achievable's FINRA podcast, hosted by Tyler from Achievable with Ken Finnen on the show with us today. Achievable has courses for the FINRA SIE 6, 7, 63, 65, and 66, and you can try each of them for free at achievable.me. And if you like it, the code podcast gets you 10% off when you check out.